Welcome to a fundamentals walkthrough of McDonald's Corporation, ticker MCD. This is a Q2 2026 snapshot built from SEC Edgar filings and cross-checked against current market data. Here's the puzzle. McDonald's turns nearly a third of every revenue dollar into profit, $8.56 billion in net income last year, a net margin of almost 32%. And yet its book value per share is negative at minus $1.81. That's not distress. It's the fingerprint of a decade of debt-funded share buybacks. And understanding that mechanism is the key to reading everything else correctly. Here's the model. Assets always equal liabilities plus equity. McDonald's has $60 billion in assets, funded by about $61.3 billion in liabilities, including $40 billion in long-term debt, which pushes equity below zero to roughly minus $1.3 billion. Borrow cheaply, buy back more stock than retained earnings support, and equity eventually flips negative. That's a financing choice, not a red flag. Look at the income statement instead. Operating margin, 46%. Net margin, nearly 32%. Return on assets, 14.3%. Diluted EPS, $11.95. These are best-in-class numbers, powered by a franchise model where franchisees, not McDonald's, absorb most store-level costs. Now the balance sheet. Debt to equity comes out to minus 31 times. Technically correct, practically meaningless, because the denominator has gone negative. Better lenses, debt to total assets, about 0.67 times. Net debt to EBITDA, around 2.6 times, which is entirely industry typical. And interest coverage, comfortably above 8 times. Against peers, McDonald's leads on margin, 46% operating margin versus 29% for Yum Brands and under 9% for Starbucks, which is mid-turnaround. On valuation, McDonald's trades at a moderate 23 times earnings versus 28 for Yum and a stretched 78 times for Starbucks, reflecting depressed earnings there, not necessarily a growth premium. Weighing it out, the bull case is margin leadership, $79 billion returned to shareholders over a decade, and inflation-insulated franchise royalties. The risk case is a balance sheet with less flexibility in a downturn, $40 billion in debt exposed to refinancing risk, and a multiple that assumes growth continues. Consensus price target sits around $324. Informational only, not advice. That $79 billion figure is the real story. 43 straight years of dividend increases, a 2.7% yield, share count down slightly again just this past year. This buyback engine is exactly what created the negative equity we saw earlier. Which brings us to return on equity, reported at minus 666%. That's not value destruction. It's just what happens when you divide profit by negative equity. The formula holds, the meaning doesn't. Switch to return on assets at 14.3%, or an approximate return on invested capital in the high teens, and the picture becomes interpretable again. Full sourcing is on the resources slide. SEC Edgar, Macro Trends, StockAnalysis.com, Guru Focus, and the Forbes Capital Returns feature behind that $79 billion figure.